I guess we should not overly panic about what's going on in bond markets. And I don't know, it doesn't seem like the stock market really is anyway.
Yeah, well, hi, nice to be with you, Kelly. Yeah, I mean, I think the upshot here is one that we were expecting a big, beautiful bill. This is, maybe bigger than some investors had expected, maybe more front-loaded in terms of the new tax cuts, the no taxes on tips and no taxes on overtime, et cetera. Those really will start actually hitting the economy in 2026, if not maybe a little bit beforehand. So those are, from an economic perspective, actually, we're going to probably see more upside than maybe what people expected. But obviously, the bond market is sort of digesting some of the bad news, not only the Moody's downgrade, but obviously this bigger bill as well. I think the upshot, we're telling our clients
on the point, Libby, that you just said, not to interrupt, but just to highlight this point, because this is the entire essence of the debate, right? Is the bond market selling off because of the debt and deficit implications of this bill, or to the point that you just made? The fact that some of this stimulus, let's call it, these tax cuts are now more front-loaded, is it possible that yields are rising on better real growth expectations as a result, and therefore it's not a panicky move, but rather one that would explain why risk assets are higher as well?
Yeah, I mean, I think that's exactly right. I mean, I think it's sort of all of the above, honestly. I mean, there is definitely some indigestion because of, this expectation for more deficit issuance that's already adding to this very big collective, debt pile, but also that this is going to be stimulative. And again, probably more stimulative than maybe folks had expected. We were expecting that a lot of the additional tax cuts would be more front loaded to try to offset some of the drag from tariffs in particular. But this is looking like this could add about 0.5% of GDP from a growth perspective in 2026.
Wow.
I think something that's interesting, Kelly, is that a lot of these tax provisions were made retroactive to 2025. That's unusual for a tax bill. And so that means that folks who are filing their taxes come spring of 2026 will be able to get some of these tax cuts from the 2025 tax year. So I think the upshot here, again, is that this is going to be maybe more stimulative than folks expected, maybe bigger than people were expected. But I think to your point, your question earlier about the cleanest dirty shirt, what we're telling our clients, the dollar will remain the reserve currency. We think obviously the fact that people are asking the question is notable, but our view is yes, of course it will remain the reserve currency. And also, Kelly, if you look at just the real yields here, they're pretty high, they're pretty attractive. So there is actually some buying opportunity. We, like lots of others, are sort of avoiding the long term of the curve, long end of the curve. Mm-hmm. But we do think that U.S. duration is still attractive, particularly in the belly and the front end of the curve.